But maybe what was the standout announcement for you, Neil, from this week's Jeremy Hunt budget?
Well, I think the thing that...
Do these events typically have much impact on markets? I mean, I know the last one did. But
you've almost got one budget there and one budget there. It's almost like the absolute opposite of what we saw previously.
Tax rises, things like this, Neil. What can clients do to mitigate some of that? I mean,
it's been a really, really strong month for performance. I think
I can't let you go with asking about Trump, because I always think, I watched this. Anyone think he'll actually succeed around the table?
No.
Will he become president again?
Well,
brave, Neil, to turn up today, even though you could have cried off, but you didn't.
Yes.
You're determined to do the podcast, weren't you?
Yeah,
I'm just slowly shuffling away. Hello everyone, and welcome back to another True Potential Do More With Your Money podcast. It's episode 143 this week, and with a slight sense of deja vu, we're back talking about a budget, and we're going to do that today with Chris in the studio. Raj is back, and Neil is here as well, and we're going to be talking about the budget, the autumn statement, and what it means for you and your money. But it's not just been the autumn statement this week, has it, gents? There's been an awful lot going on. We've had a G20, we've had an inflation report, the return of Trump, maybe, who knows? An awful lot going on. So much news. There's a lot to pick out this week. So we'll get into all of that over the course of the next half an hour or so. But Chris, give us the initial. How have the markets reacted this week to all of that news? Has anything in particular moved markets more than anything else? And how are we looking so far for the month of November?
Yeah, it's actually been a fairly muted week for markets. I know it sounds really odd when you think about all the different events that we've been talking about. Again, autumn statement. UK inflation coming in at 11.1%. The return of Donald Trump. Who knows how that will go. And obviously a lot happening in China as well, with zero COVID and the potential to pull back on that. What I would say is, actually, if we look over the month, it's been a really, really strong month for performance. I think if we look at equity markets and how that's then factored into True Potential portfolio performance. So True Potential balanced portfolio over the last 4 weeks is up nearly 5%. And the aggressive portfolio is up nearly 6%. So even though maybe people are sitting at home and thinking like, I watched the news last night, it was such a depressing thing to watch. Actually what you've seen is really good returns.
Yeah, that's good news. That is great news. I mean, also, we talked about the G20 as well. But the House of Representatives, we were talking about Trump and the House of Representatives this week. There was the other side of that, which was that the Republican Party got over the line and now controls the lower house in the States. Have the US markets, Raj, moved at all this week in either direction on the back of that, or Trump, or what happened at the G20? Has there been any movement on that side of the pond?
Inflation data which came out last week in US, which calmed the rates market down, which has mellowed down the volatility across equities, across currency markets. And also, if you look at the earnings picture, have been people who markets were fearing earnings will take a big lurch down. That hasn't materialized because companies have been able to pass on the costs, been optimizing their operating costs. So overall, earnings have held reasonably better than expected. Of course, it is benefited from energy sector, one particular sector. But I think all those factors have meant that the overall stability in the market is much more expected. Not expected, but I think it's much more normal market conditions.
It's interesting, actually. One of the things that Raj and I look at is what we call the VIX index.
Yes.
So that's basically, it looks at 30-day S&P futures, which is probably getting a little bit too technical for this podcast. And it looks at the implied levels of volatility. And what does that mean in kind of layman's terms? What it means is basically it looks almost at the amount of fear that there is by investors looking ahead.
Okay.
And if you look at how that's moved since over the last 6 weeks, probably taken about a third out of that index.
Right.
So there is a feeling right now of maybe things are a little bit calmer. I don't just think that's actually at a kind of stock market level or an asset price level. I think as well as that, with what we've seen with the change in government, change in Prime Minister, Chancellor, you do have something that is a lot more market friendly and just a lot more stable.
Yeah. I mean, would you say that's the first time maybe in the last 12 months we've had a period of, because it's been very choppy, hasn't it, this year? Some good opportunities have been created in the volatile times, but we know it's been a bumpy ride. But do you think now, are we now entering a period of a bit more calmness, do you think? Is it too early to say?
I think for me, no, look, it's still too early to say.
Okay.
You know, I think there's a lot of things that are still out there, but I think, you know, the key point for what Raj and myself have been doing is we've had a lot of cash, and that's been great. That's been really, really helpful when we think about what's happened so far this year. But actually, because you've seen equity markets and bond markets cheapen up so much, you're actually seeing some really strong, favourable entry points coming through. So what we're seeing now is actually cash balances start to come down and money start to be invested in fixed income, in equities, and that's basically that valuation opportunity coming through. So even if you were to see you know, some volatility over the short term, the reality is that the long-term opportunities right now are really attractive.
I think it's important to say yes, some of those factors like inflation was continue becoming higher and higher. Over the past few months, especially in the US, we have seen that peaking out inflation. So that pressure has taken away, and some of those central bank tightening conversations have probably taken a little bit of softer tone and a backseat. We saw a couple of Fed governors coming up and saying that we are probably closer to the peak hiking cycle. So that has helped in the markets. Geopolitical tensions are probably taking a little bit back seats. Stability in the political events in US and in the UK are behind us. So I think it looks calmer because of that. But I think inflation is going to continue to be one big factor which will drive market direction for us, and that's.
Well, let's bring Neil in, because you mentioned geopolitical environment. We've talked about, you know, Trump, the G20, international relations, the House of Representatives. I mean, Neil, you know, we know that international politics is a particular pastime of yours. So you like to keep up with what's going on. Do you want to? Actually, no. Sorry, I've read the wrong bit there. Sorry, I'm on the wrong page. From a client's point of view, the sort of the bit more stability that we've seen in the performance of the portfolios that Chris has been talking about, feeding through to clients. I mean, clients logging into their app will be able to see that reflected, won't they? A bit more stable now, perhaps.
Yeah, I mean, like Chris said, the past couple of weeks have been particularly good for the portfolios. We normally get an increase in the amount of calls that maybe's come into the central advice team when there is more volatility within the market. The last couple of weeks have seen a real big reduction in that. Excuse me. And what it also plays out is to the message that we keep giving to clients about keeping invested for the medium to long term. It's a really important point because, previous to the last 2 or 3 weeks, we did see a heightened level of volatility with certain things. And, a couple of weeks before that with the disastrous mini budget that the government set out, where we're seeing it really did affect the markets and the volatility. But this is the message that we sort of not preach to clients, but, replay back is it is a medium to long-term investment. Please view it as such. And that's proven to be, how it's played out over the last couple of weeks. I think the market has obviously got some more improvement in it, but when that'll be, we don't know. I don't think anybody could particularly say that, but clients are a lot more confident now, and they're also a lot more confident when they speak to their financial advisor.
Yeah, which is always the best thing you can do if you need a detailed conversation. You mentioned the mini budget in there, which gives us a lovely segue. Thanks very much for doing that. Into this week's budget autumn statement. What was it? Financial mini. I don't know what they were going to call it. But autumn statement or budget in layman's terms. But anyway, let's get into some of the details about what was in it. I'll ask you all maybe just for one highlight, because there was a lot of other detail in there and a lot of financial numbers and forecasts and things. But maybe what was the standout announcement for you, Neil, from this week's Jeremy Hunt budget?
Well, I think the thing that got the biggest cheer was the triple lock about the guarantee, about the state pensions, which, I think if you watched the live sort of feed, it was a big area of debate and whether or not he was going to stick to that. A couple of things from an investment point of view that stood out for myself was the change in capital gains tax. Allowance. Yes. We all have a personal allowance, so if you have maybe a general investment account, as an example with True Potential, if there's any growth in that, you do have, it could be liable to capital gains tax at some point, whether you take money out or wish to access those funds. That personal allowance was 12,300, and now it's gone down from 12,300 to pretty much to £6,000. And then it's also going to be down to 3,000 from April 2024. Right. So that's the biggest thing for me from an investment point of view. From an advice point of view, what does that really mean? Well, clients have got less of an allowance from a capital gains tax point of view, but also it might mean that they may wish to put some more money into their pension, because the pension isn't subject to that, and that will allow them obviously to get tax on top of that from the government as well.
The tax relief that goes on top of
the
it.
tax relief.
Yeah.
So that'll probably include in a lot of our conversations with clients when we come to do their reviews and the forthcoming couple of weeks.
And what other sort of items, if you like, might incur capital gains tax? You mentioned the general investment account, that sort of investment. Are there other sort of assets that?
Yeah, there's a whole range of stuff. That could be subject to capital gains tax. I think obviously the main thing will be the investment account, because that's what our customers will be affected by. But there are ways to mitigate it. But if you're worried about it, what I would say is have a conversation with your financial advisor. Do
you generally find that after budgets and statements and things like this, that the phone calls to our team and to advisors shoot up? Because you're not going to get into the details of your own portfolio just by reading the news. I mean, you've got to. It's very much a personal thing and how it affects your investments. Is this always a heightened time of contact from clients?
Yes.
Or if it's not, would you advise that they should do that?
Yes, and it's also as well, we've touched on it in the past, very media driven. Clients will watch their TV at night and think, I wonder how my investment's doing. I'll give the team a call. And also as well, the great thing about having the app or having the technology is that when you do log on and you view your investment amount, it has a lot of the budget videos on there. It has a lot of the morning markets, which we talk about, current thematic stuff. So yeah, it's always in the forefront of customers' minds, and customers are getting very, very clued up about their finances now. Sure. And that does engage them a lot with our financial advisors.
Okay. So for you, CGT, reduced allowances over a period of time could affect your investments, but there are maybe things you can do to mitigate that.
Yeah.
So as Neil says, pick up the phone to us, speak to your advisor, and we'll talk you through it. Chris, what stood out in the budget for you?
So maybe something, and this isn't the budget, but I will talk about the budget in a minute. The one thing that didn't stand out to me is I watched quite a lot of the news last night. So I watched the kind of main Sky News, BBC News, and it was so incredibly negative. And I was sitting there thinking, if I was watching this as a client, I would be very, very nervous and it would make me feel quite uncomfortable. There was no way of... They weren't there to sort of explain why it was happening. They were just there to say, these are all the things that are happening. And just kept on saying...
I noticed that, by the way, as well.
Incredible.
What went through my mind on that point was the mini budget 8 weeks ago, got slated. and this one yesterday was the opposite of it, and that got slated. And what can you do here? Either we're going one way or we're going that way. But whatever we do, we're getting. Why did it get such a negative reaction, do you think?
Well, I think it got such a negative reaction because it will affect people's incomes. I think there'll be a timing issue around that, which I think we'll talk about in a little bit, with actually a lot of it being sort of backloaded. But the reality is you've got tax rises, you've got freezers on basically income tax allowance levels. There are a lot of things there, but the government needs to raise money.
Well, would you just on that point, would you maybe just give people who perhaps, some of us maybe stop watching a bit of the news because it is quite negative at the moment. It has been for a long time.
Yeah.
For people who perhaps missed the news last night or whatever, how did yesterday's budget contrast with the one 8 weeks ago? Give me a feel for how they were very different.
You can see I'm laughing because you've almost got one budget there and one budget there. It's almost like the absolute opposite of what we saw previously. So previously was all about trying to use growth as a way to grow us out of where we are right now. So what you saw was basically a view that we were going to reduce income tax for the highest earners. So get rid of that additional rate, the 45% level. A lot more spending. And the other thing with the budget was there was no OBR forecast.
The one 8 weeks ago.
Yeah. So what does that mean? It means that you announce that to investors who are investing in sterling, in UK bond markets, in UK equities, and you're doing that, and obviously it came as a shock. And that's where you saw that incredible volatility, particularly in UK bond markets, come through. And the reason for that is because you're spending a load of money, but you're not saying how you're going to pay for it.
Yeah.
And then what you've now got is obviously new Prime Minister, new Chancellor, and the exact opposite of that. So you've got now basically them saying, actually, do you know what? We're going from fiscal largesse to fiscal austerity. And within that, what we're doing is we're basically increasing taxes and we're trying to raise money to pay for all the things that we need to pay for. So it's like almost diametrically opposite of what we saw before.
And as you said, perhaps the media, which they always tend to do, you know, take a very extreme, very, what's the word? Maybe not extreme, but you know, it's one way or the other. It's heightened for television.
Yeah.
With the markets, which is the really important thing, because that's what affects everyone's money, as you said earlier.
Just nothing.
Took it in their stride.
It's
Which
fascinating.
is what you want.
It's
You want them just to
fascinating.
be calm about the whole thing.
I think it's the opposite as well. What Chris was saying as an example of the opposite would be that the additional rate taxpayers, which they said they weren't going to tax as much, and now yesterday they've reduced that.
There were going to be fewer of them 8 weeks ago, now there'll be more of them.
Yeah, but that'll pull in an extra 250,000 people into that bracket. So you know, it's completely the opposite.
Yes.
It is fascinating. We were looking at the charts earlier, and we look at, we've obviously got Bloomberg system, so we're looking at kind of minute by minute, and you can see how UK asset prices change. So you can see the announcement of the autumn statement. And I was looking at gilt yields, so UK government bonds. They basically just do that afterwards. I think maybe one of the things for me that was quite interesting and actually thought was quite good was the fact it was so well communicated beforehand.
Yeah.
So there wasn't really any shock in there.
Yes.
So in some ways, the market shouldn't have reacted because everything was priced in.
Do you think maybe there was like a little, I don't know, pamphlet produced inside the Treasury or number 11 to say, the plan for this one's going to be, you know, the last one?
Yeah.
Just do everything the opposite of that.
Yeah.
The way we announce it, the people are everything the opposite. We don't need a plan other than just do the opposite.
Prepare the people.
Because it is always, I mean, you know, was there anything, excuse me, was there anything yesterday that we didn't know was coming, in your view?
I think there's one thing is I agree with all Chris has said. I think it's diametrically opposite. But if you look at, there's one thing. It may sound like a fiscal austerity type, but if you look at the details a bit, it's probably less to because they have tried to push it as far as possible.
Yeah. So is it right that for the next 2 years we're actually increasing all the increasing things like the energy price guarantee, things like this?
So the price, energy, the windfall taxes and the high earner taxes starts in the front end of it. But all the fiscal cuts and spending cuts are way back in beyond 2025. So
why do you think that might be, Raj? What do you think is happening? Perhaps what do you think might be happening in, I don't know, say 2024 that might mean that he wants to put this stuff after 24 onwards?
I'll let you do the election bit of it.
That's not political consultant here.
But
Neil, what's happening in 2024?
I have no idea.
But I'll tell you what my take from investment and from economic perspective, what it provides us is that government in Germany, Hunt, is probably trying to balance the recessionary outlook and the slowdown in the economy, which is already underway, to not make it lot more worse from here. And I think that balance was important, and I think markets probably took that balances in that stride. If you look at try to peel the onion layers, it's not immediately next 2 years where household spendings are already strained by inflation, and you load them down with further cuts and further austerity is not going to right way. So I think that balance is probably missed in markets. I think the reaction in the sterling market, was a good example of it, balancing the long-term fiscal discipline with shorter-term not killing the growth, which could have taken a hit on sterling itself. So I think in my mind, they got a right balance for immediate term that the households will be constrained in the squeeze and the spending, so not loading them further with austerity was an important one for me.
The election in 2024 is what we were talking about. The general election probably going to be in 2020. Well, it will have to be in 2024, if not sooner. And I doubt it's going to be sooner. So, you know, this makes it the next Chancellor's problem. Or Jeremy Hunt, if he still is Chancellor after the next election. But yeah, you're deferring some of the pain. It seems to have what's going on. Tell me about the energy price guarantee, because there were some changes to that, weren't there, in terms of the generosity of it or the level, but also the time period. What's gone on there?
So I think what the media has clearly focused on the 500 increase in the price cap from raising from 2,500 to 3,000 yearly. But I think what is important, missing, it has been lengthened by an year as well.
Yeah.
So I think it's an important process, given a lot more scope for running it further down than previously announced by Jeremy Hunt.
Yeah.
And also, there's enough support to be provided by the more constrained households and also vulnerable group. So there is another £900 annual allowance for the households which are struggling.
Yeah.
And there is also for disabilities and other vulnerabilities there also further support. So I think it may sound that there's £500 took a lot of airtime, but I think if you look at, there's enough support. And importantly, I think Jeremy Hunt didn't commit himself into not doing further if need be. That he has not completely ruled out taken this off the table as well. So I think there's always scope. And the final point is that the energy prices, as it seems like, probably has peaked in August. And they continue to come down. And all the numbers and these caps are calculated based on the higher energy prices. And if global economy is slowing, and we know it is slowing, energy prices have been coming down. So, and the actual end spend for a household may not be that much anyways.
Yes.
If this continues. So I think in all, I think it captures the imaginations, but in reality, much less impactful to households.
Do these events typically have much impact on markets? I mean, I know the last one did, but was that an outlier? Generally, do markets take these kind of events in their stride?
So, from my opinion, that is normally an outlier. So I think, the government have learned from what happened in September.
Yeah.
And this is why it's been so well communicated. I think the second thing as well is, it's a market-friendly budget. The reality is that you are coming out and saying, look, we've got forecasts here. We're going to raise taxes. We're going to be fairly austere. I know there's kind of timelines around that, which is quite interesting. But it couldn't have been more market friendly. All of it's priced in, so you were told beforehand what was going to happen.
Yeah. And in terms of tax rises, things like this, Neil, what can clients do to mitigate some of that? I mean, legally, obviously. What are some of the most tax efficient ways that people can invest, can save?
Yeah.
What would you say?
An ISA and a pension are probably the most two tax efficient, really. We just talked about the lowering of the capital gains tax allowance, which means that you're not going to be getting a lot of cover from a capital gains tax point of view. So what I would suggest is, if anybody has a general investment account or a unit trust or anything like that, and they're worried about going over and breaching that capital gains tax, there are other ways that we can mitigate that by maybe putting more money into their pension, getting tax relief on that, dependent on how much money they earn. So it's always a conversation to be had with a financial advisor. And like you said before, when these budgets do come out, we do get an increase in calls in certain areas, because people think, I wonder if I could maybe mitigate this, or put more money into this.
Well, the other thing that mitigates the inflation rate that was this week was 11.1.
11.1, yeah.
Right, so that's even your best savings rate in a bank account is going to be 1-2%, that sort of thing. So nowhere near the inflation rate.
Yeah, and you're lower.
But the interest you'll get, what you were saying is that the balance in our aggressive funds are perhaps 3, maybe 4 times the rate you'll get in a bank account. I mean, they're just much better growth in terms of the portfolios.
Yeah.
So if you are saving, I suppose what I'm trying to get to is, if you're saving a little bit each month into just putting it into your cash ISA in the bank or something, you're not going to get anywhere near inflation. But you could achieve 2 things by investing it. You could get closer to inflation, beat inflation in some cases. Obviously we're in quite a high time at the moment, but generally, but also do it tax efficiently.
Yeah, and more
with an ISA or
importantly,
pension.
yeah, and more importantly, an ISA is obviously typically known for being capital gains tax free.
Yeah.
So that's a great way. You've got £20,000 allowance there. Not most people don't fill up their £20,000 allowance in a year, so it's obviously for the majority of people. And probably looking at, just touching on what Raj was talking about before, by the extra payments coming in for the energy and stuff like that. People may be struggling in certain areas with regards to additional bills or additional expense, but there has been a lot of other things increased, like the living wage, which is going to increase to next year, and also as well, we've got more help in the energy sector, like Raj said. So people may find out that they do have a little bit more to spend, but it's also worth, what we do is, from a financial advice point of view, is we do income and expenditure. So we go through a fact find, we look at whether or not your income and expenditure has changed, whether or not your outgoings have changed, and what that does. That may have an impact on the amount of money that you can save every month. You might want to put in a little bit more. But also you might want to think, well, I might be subject to capital gains tax. Let's put more money into my ISA.
Yeah, I'm not. If I'm leaning away, by the way,
Sorry.
it's just. I know you're suffering from man flu, aren't you?
Yes.
We can tell.
I am.
Very brave, Neil, to turn up today, even though you
Yes.
could have cried off, but you didn't.
Yes.
You're determined to do the podcast,
Yeah.
weren't you?
Yeah,
I'm just slowly shuffling away.
I was tempted to have a hot toddy this morning, but I don't think that would have worked well with the
You
car.
can keep your hot toddies to yourself. If any of us aren't here now, by the way, next week on the podcast, if we're all in our sick beds, it's all thanks to him, by the way. We'll all be coughing and spluttering next week. I forgot what I was going to say. Tell us something that stood out for you. I know we've done all that, haven't we? I know what I was going to say. If you are wanting to invest, if you find yourself now, okay, we know tax rates are going up, we've covered all that. But wherever you are, whether you've got, a good extra cash at the end of the month, or you just think, you know what, I want to start my investment. I hear what you all say about inflation and cash accounts. I'm going to do it. I'm going to start an investment account today. With Impulse Save, with the True Potential app, anybody, it's accessible to anybody, isn't it? What is the entry point?
Yeah, I mean, it's, you can start investing from as little as £1.
Yes.
You don't have to receive financial advice to do that. You can self-invest.
Mm-hmm.
You can go download the app. You can register. You can register your debit card, and then you can start saving a monthly amount via direct debit. What we always say is it's wise to treat it like a bill. It can accumulate over the next couple of years to be quite a substantial amount. Chris was talking about how great the aggressive and the balanced portfolio have been doing in the last 3-4 weeks. So yeah, the growth is there. The growth is there, available. The opportunity to save if you do have spare money every month is there. And like we said, it's good financial planning is to put a little bit away each month. Yeah. We've talked about pound cost averaging on previous podcasts. So you're not taking a hit by putting a lump sum in. What you're doing is you're taking it out your monthly wage every month, and that's a lot safer for a lot of people because they don't like that big hit. And if you have free cash every month, why not put it into an investment?
And if you have a pension somewhere else that you're not happy with how it's performing, or you've got a cash ISA somewhere that you think, well, I'm getting nothing on this. If you wanted to transfer that across to True Potential and do it, and invest with us, easy to do.
Easy to do. It's always wary a little bit on pensions because they may have some sort of guarantee on there. So it's always wise if you're unsure to speak to a financial advisor. We can have a look at what pension you're currently in. And view whether or not it's right for you to move that over from an advice point of view. But you can still transfer in via the client side from a sort of an own point of view. And then also set up a direct debit as well to go on top of that.
Good point. Right, I wanted to talk before we go. I can't let you go without asking about Trump, because I always think, I watched his speech in the week just for a bit of humour, really, and it was very humorous. Some bits of it, probably not for the reasons he thought it was funny, but anyway. From an investment point of view, can I just take you back to when he was president? Because we might get him again. I mean, I know it's unlikely this time, but we might. Did he create opportunities? He was very in his speech in the week. He was very keen to sort of push this message. Some of it, I accept, only exists in his head, but he was very keen to tell us that the markets were, the economy was flying along when he was president. It was great. Did it create opportunities for you? There was a lot of volatility, but was that good for you guys in your job?
I mean, it was good and it was bad, which is often not a great answer. So
just get off that fence, Chris.
It's really comfortable on that fence. So why was it bad? It was bad because if we think of like the final quarter 2018, US-China relations, the trade tariffs, that was bad and that wasn't good for stock market return. I think if you look at the kind of full tenure of when Trump was in power, you almost use the stock market as like a scorecard. Right. So we always used to talk about, well, US equity markets are up X%, and then just factor it into, it was all down to him, which it wasn't. But what you did see during that period was really strong equity markets, and I think that's where he's going when he talks about a strong economy. I think he's probably less talking about the economy and more talking about stock market returns. So
good for investors then.
There was lots of other reasons why stock markets were doing well outside of Donald Trump at that point. Things like really low interest rates, low inflation. stuff like that. Really strong performance from the kind of big US tech companies. So I wouldn't say that was all down to him. What I would say is there's obviously a lot of litigation that is centering around Donald Trump at the moment. There's various different civil suits that are against him. How will that affect his ability to attract funding? It may or may not. And yeah, I mean, he's a real wild card. You know, it's the kind of opposite of what we have in the UK. You know, there's no stability there. Yeah. But he is, you know, he has very specific ideas. He is very business friendly, and he is very determined to basically, I was going to say, make America great. Then I don't know why that came in my mind. But he's very.
You'll be putting your Trump cap on in a minute.
I will, yeah.
MAGA on the front of it.
But he's very.
It's interesting that you say that he's the opposite of Britain. That he's unstable, as if we've had a period of stability politically in this country. But I think that's probably a good point to wrap this up and get off the subject of politics quite quickly. Anyone think he'll actually succeed around the table?
No.
Will he become president again?
Well, you don't know with America, but I would.
You don't know with any.
I would say
say
no.
us Brits.
I would say no.
No.
I would be in that camp, no camp.
No.
I'd be surprised, but I wouldn't. I'm sitting on the fence on it. I'd be surprised, but I think there is a chance that it could happen.
Oh.
But I'd be surprised.
That sounds like a well. I'm gonna hold you for an answer here, Chris. You know,
So
is it a yes or a no?
So we look at things like probability.
Just a yes or a no will do. Just a yes or a no will do.
Okay, I'm going to go with no.
All right. Well, I'll say yes, only so that if in a couple of years' time it happens, we can go back to episode 143, and if he doesn't, we'll never watch this one ever again. Well, look, thank you for your analysis of this week's budget and what it means for investors and when things are going to be happening. And I think, Neil, you've said it a few times in the podcast, as has been echoed by Raj and Chris, that just speaking to your advisor is always the best thing. It is anyway. It's always the best thing to do. But especially when you get a week like this where there's some changes in tax rates and changes in allowances and things like this, it's just always good to get a bit of advice. And ring us here. Yeah. There's a whole team upstairs so you can take a call, or live chat or video chat or whatever, so we can help you pick the bones out of it and work out what's potentially the best thing for you to do. So thank you, everyone. Thank you. Well, I hope by the way, your cold gets better. I hope it doesn't get any worse.
No,
and I hope you haven't spread it around the table. It's going to really ruin my week next week if you have, but never mind. I've actually just had it myself, so I'm probably okay.
Well, at least you can be off work.
Well, nobody say anything.
Thank you. Cut that bit out.
Yeah, exactly, yeah. Thanks very much. Thank you, Chris. Thank you, Raj, as well. Thank you very much for watching this week. I hope it's been useful. I'm sure it has. And as I always say, the best way to get more of our content, whether it's Morning Markets, the podcast, and everything else as well, from these guys, is just to hit that big red subscribe button, give us a like, and we'll give you a thumbs up if you do that for us as well. So thanks very much for watching, and we'll see you next time.
If you're interested in taking your investing to the next level, or would like to know more about the options available to you when you retire, then download our free guides to ISAs and pensions. These are available in the video description below.